Let us have a look at Bajaj Finance, an NBFC that has quickly risen among the ranks to become one of the largest NBFCs with respect to the market capitalization. This is the business model that I see the way Bajaj Finance looks like. Bajaj Finance caters to mass affluent and above customers in rural and urban areas. It caters to individuals and institutions. The company has apparently mastered quick loans and approves loans within 30 seconds. It has introduced the concept of EMI cards for existing borrowers. The company seems to have a multi channel customer acquisition strategy. Customers can avail loans via Bajaj Finance branches or through the agents who can be reached in third party stores like Chroma. Customers browsing on e commerce platforms can avail no cost EMI loans while making their purchases. The company has multiple revenue streams. Consumer loans like consumer durable loans, loans to buy digital and lifestyle products, auto loans to buy two, three, and three-wheeler loans, personal loans to salaried individuals and existing customers, and home loans. The company also provides SME loans that comprise of working capital loans and loans to professionals like doctors, engineers, and chartered accountants. Company is active in commercial loan segment as well, where it does vendor financing, warehouse financing, light engineering financing, etc. The company also earns fee income by selling insurance products. It has tie-ups with RBL Bank to market co-branded credit cards, and it also has the tie-up with MobiKwik for wallet products. The company Bajaj Finance is structured into the parent company and two subsidiaries. The parent company handles the consumer, SME, commercial, and rural lending. Its subsidiary Bajaj Housing Finance Limited handles housing loans, loans against property, and developer loans. The recently eked out subsidiary Bajaj Financial Securities Limited handles loans against securities and will handle demat and broking services in future. Now Bajaj Finance is spreading out of the top 30 cities and actively entering into tier 2 and tier 3 cities. It is increasing its presence in third party stores like Chroma in a big way. The graph on the left side shows that as of Q2 FY19, the company is present in 63,000 stores in urban areas and about 11,000 stores in rural areas. These are the third party stores that we are talking about. The company is expanding its own branch network at a brisk pace. The graph on the right side shows that the company has about 860 branches in urban areas and about 750 branches in the rural areas. Now, the assets under management, Bajaj Finance has been expanding its asset base at a very high, fast rate. Over the past 5 years, the assets have grown at least by 35%. In FY18, we saw the assets grow by about 40%, in fact. Now, coming to the borrowing profile and cost of funds, the company has a diverse borrowing profile with bank loans and term loans making up 34 and 35% of the borrowings respectively. The company has consciously grown the deposits and it now makes up about 15% of borrowing. Out of the 11% short-term borrowing that we see, commercial paper makes up close to 9%, and these numbers are as of Q2 FY19. The graph on the right side shows that the cost of funds as of Q2 FY19, the cost of funds stands at 8.2%. There is a decreasing trend seen in the cost of funds over the past 3 to 4 years. This is partly due to lower rates from banks and increasing contribution of deposits in the borrowing profile. Now the graph on the left side shows the net non-performing assets over the past 7 to 8 years. Over the years, the net non-performing assets has increased but the company has managed to keep it at less than 0.5%. So if you see the graph, you will see that It's hardly crossed 0.5%. Now, if we break down the net NPA numbers, we see that the auto finance is the major contributor to the NPA. The company has now gone slow on the auto loans right now due to this. Please visit our website to read a detailed NPA analysis and breakup for the company. The link is given below. The company has managed to keep the return on equity at a level that is more than 20%. Over the past 7 years, it has maintained this value. Management guidelines for the future hovers in the range of 18 to 20% for return on equity. The return on assets has stayed above 3% all these years, and it is inching towards 4%, which is one of the best among all the NBFCs. I hope that the company is able to maintain these levels. Regarding capital adequacy ratio, if there is one thing that has disappointed me, it is the capital adequacy ratio numbers. Due to the frenzied growth, the Tier 1 capital keeps coming down and the company is forced to dilute its equity once every 2 to 3 years. Management has a 14% cutoff on Tier 1 equity, beyond which it will enter the market to raise the capital. The graph on the right side shows the consequence of dilution on existing shareholders. In the past 7 years, the company has diluted equity 3 times. And in all these 3 years, the EPS has lagged the profit growth. I guess this is a necessity evil which one needs to live with. Now, with respect to risks, Bajaj Finance, like any other lending agency, is subject to risks. Listed here are some of the points that might help in understanding the uh, counters to the perceived risks. Its debt is rated at AAA stable by many rating agencies. It survived the recent NBFC crisis and was able to raise new commercial paper. Its net NPA has been lower for quite some time now. Its asset liability mismatch is on the positive side that leaves enough room for growth. The company has a sector or product wise cap and does not lend beyond a certain percentage of its own loan book. The company lends only to mass affluent and above customers who are capable of repaying back the loan. So this was a very quick summary of Bajaj Finance. A detailed analysis of the company can be read at the following link. Thanks for listening.